How much risk should you be taking right now? Here's how most people answer that question. They fill out a questionnaire. How would you feel if your portfolio dropped by 20% or 30%, and it measures their stomach? Or they'll use a rule of thumb, 110 minus your age in stocks, and it measures their birthday. Or they just pick a mix and call it a day. But notice what none of those measures though. What you're investing your money for, your future spending, and what that future spending actually requires your investments to grow. I call this your investment hurdle rate. Your stomach doesn't know your hurdle rate. Neither does your birthday. And that's why so many household investors, particularly pre-retirees and retirees, are taking the wrong amount of risk right now to both ends of the spectrum without any idea that they're doing it. There are two ways to take the wrong amount of risk, and only one of them feels dangerous. I'm Michael Carbone, a CFA charter holder, a certified financial planner, and a partner at a financial planning practice in Greater Boston. If you're new to this channel, I work with people who are serious about getting retirement right. And I started this channel to help you make better retirement decisions, period. So any honest answer to the how much risk should I take question has to answer three separate questions. Question one, how much do you need to grow your money by in order to fund your future spending goals? That's your investment hurdle rate. If your financial plan requires your money to grow at 6% compounded on average, some amount of stock exposure will likely be required to even have a chance at it. If your financial plan requires 3%, you may not need any money in stock. Question two, based on your timeline to needing withdrawals from your portfolio and the amount that you'll need to withdraw, how much volatility can you afford to accept? That's your risk capacity. When markets have a prolonged period of poor returns, does your plan bend or does your plan break? This really has nothing to do about the size of your portfolio. A retiree withdrawing heavily in their early years has less capacity for volatility than one whose Social Security covers most of their ongoing spending. And finally, question three, how much volatility can you personally stomach? This matters a lot because the best investment strategy on paper is worthless if you abandon it at the first sign of market volatility. But notice what it is. It's a constraint on the answer to the question of how much portfolio growth your goals require. It's not the answer. I don't think that the financial services industry gives you, the household investor, enough credit. Most advisors tend to start with question three and stop there for fear of overcomplicating things. And I get it to some extent because it is complicated, but I'm going to argue that the entire decision can very easily change when you start with question one. So how much risk or volatility do you need? To answer that, you need one very important number first, and I've already mentioned it. It's your investment hurdle rate. Again, your hurdle rate is the least amount of growth that all of your money would have to earn from dividends, interest, and gains combined from today until the end of your plan to fund all of your future withdrawals. It's not a market forecast, and it's definitely not a rule of thumb. It's calculated from your own numbers, how much you have saved, and what you'll need to withdraw from those savings year by year for the rest of your life. Somebody spending modestly with Social Security covering most of their bills might have a hurdle rate of 3%. Someone retiring early with heavy spending might need 7% or more. Same size portfolios, completely different growth demands. This number, what your plan demands, is where the risk conversation has to start because it's ultimately what translates into the appropriate investment mix. At any moment, the market offers a menu. On one end, you have bonds. Bonds are typically considered to be conservative fixed income investments, and as I record this, an all-bond portfolio of high-quality U.S. government bonds is priced to deliver somewhere around 4 to 4.5% return. On the other end, an all-stock portfolio, which is currently priced to compound somewhere between 7 and 8% per year over the long haul. So the all stock portfolio, 7 to 8%, and the all bond portfolio, say 4 to 4.5%. And most importantly, if your hurdle rate is between those 2 points, the mix between stocks and bonds needed would vary. Let me show you with a real illustration. This is how your hurdle rate becomes an allocation and ultimately answers the question in the title of this video. Say that a couple retires today at age 65 with around $1.5 million saved. Maintaining their lifestyle means pulling $120,000 per year off their portfolio, rising with inflation until each spouse's Social Security spigots turn on, at which point their ongoing draw off the portfolio would fall to around $60,000 a year. The hurdle rate in this case would be around 5%. And based on what the market's currently offering, that may require a minimum of about 30% in stocks. But there's one assumption doing quiet work here. This assumes that they spend down their money to zero by age 95, conservative on longevity, and nothing left behind. So let's turn the dials and watch the output move. Say they want to leave $1 million to their kids, which is roughly $400,000 today when you strip out inflation. And say we plan to age 90 instead of 95. The hurdle rate rises to about 5.6%. And the stock requirement jumps from roughly 30% to roughly 50%, or half of the portfolio. So one decision to leave money behind and the required amount of stock nearly doubles. Now, one more layer. Suppose that they're worried about late life costs, things like custodial care and out-of-pocket healthcare costs. We'll build this in by increasing the withdrawals by 5% a year starting at age 85. Under that scenario, they need around 60% in stocks. You can see that this isn't a perfect process. Nothing that projects 30 years out into the future can be. But look at what it just did. It priced their goals. Each thing that they want, the legacy, the healthcare cushion, showed up as a number in required growth and required risk. So now they can choose deliberately. Say the care costs worry them less, but the legacy matters a lot. They'd land on the 50-50 portfolio. And notice how the other two questions fall right into place. In the 50-50 stock to bond portfolio, the bond half would cover roughly the next 10 years of their withdrawals. So they have the capacity to ride out a bad market without having to sell stocks at the bottom. That's question 2 answered, which leaves only question 3. Can they stomach it? That one's personal. But there's a world of difference between holding 50% stocks because a questionnaire suggested it and holding 50% in stocks because you can say exactly what every dollar of that risk is buying. That's what gives you the confidence to hold on when the volatility shows up. And if the mix that your plan requires is more than your stomach can take, that's not a portfolio problem. That's your financial plan asking to be renegotiated. Spending, timing, Social Security, those dials exist for exactly this moment. Now here's why this number matters so much, because when you don't know it, you can end up in one of two mismatches, and I see them both constantly. Mismatch number 1, more risk than your plan requires. Take that couple from a minute ago. Their base plan required about 30% in stocks. But suppose they never ran this analysis. What are they actually holding? If they're like most retirees today, probably a 60-40 portfolio, because that is the default that a lot of people land in, or an all-equity mix left over from their working years. That's 2 to 3 times the stock exposure that their plan actually requires, which means that they're exposed to a year like 2022 when stocks and bonds were falling together, chasing returns that their plan never asked for. They already won the game, but they're still playing. But I will say that extra risk isn't automatically wrong, because look what happened when that couple named a legacy goal. $1 million to the kids, and the required stock allocation rose from 30 to 50%. That's what the right kind of extra risk looks like. It has a name on it, a legacy, a goal, a deliberate reach. If you're holding more risk than your plan requires and you can't name what that extra is for, it probably isn't for anything. It's just a default. In mismatch number 2, less risk than your plan requires, and this is the one that keeps me up at night. Same couple, different temperament. The market makes them nervous, so everything sits in CDs and money markets that earn maybe around 4%. Ask them how retirement's going, and they'll tell you safe. But here's the truth. A plan that requires 5%, funded at 4%, is not safe. It's failing, quietly, politely, a little more every year, with no crash to ever warn them. And that's the cruelest asymmetry in all of retirement planning. The first mismatch feels dangerous, and it might cost you. The second one feels safe, and it will cost you. Only one of the two ways to take the wrong risk feels like risk. And one final case for completeness. Some plans come back with a hurdle rate above what even an all-stock portfolio is priced to deliver. And if that's you, the answer is not to turn the risk dial to maximum and hope. Past that line, more risk stops buying you potential return, and it starts buying you a wider spread of potential outcomes, including the catastrophic ones. The fix was never the portfolio, it's the plan. Spending, timing, taxes, Social Security. Risk is a tool for clearing a reachable bar. It is not a substitute for a reachable bar. Now, the words "right now" are in the video's title for a reason, because the answer to how much risk do I need is not a personality trait. It moves when the markets move. And it just moved. Go back a few years, 2020, 2021, bond yields were below 2%. The purchasable bond return was not ideal. Back then, a 4% hurdle rate required real stock exposure. There was simply nothing else on the investment menu that could clear it. So retirees were essentially forced out on the risk curve whether they liked it or not. Fast forward to today, bonds are paying meaningfully higher yields. That same 4% plan can be funded with dramatically less risk than it required 5 years ago. Think about what that means. There could be an entire generation of retirees who are holding equity allocations that they built when they couldn't get anything in bonds, allocations that their plans no longer require. And most of them have never repriced. De-risking is functionally on sale today. This is why I rerun these numbers every year. The plan changes slowly. The menu changes constantly. So how much risk should you be taking right now? Here's the honest structure of the answer. Start with your need. Your hurdle rate sets the floor, the least amount of risk that keeps your plan's math intact. Then add cushion, because markets don't deliver returns in a straight line. And the minimum risk portfolio clears your bar only if the averages cooperate. Then apply your constraints, capacity and stomach. And if your stomach or capacity needs can't hold the risk that your plan needs, then that's not a portfolio problem. That's a plan conversation. The same dials as always: spending, timing, Social Security, and so forth. And if you're taking on more risk than your plan actually requires, make sure that that's a decision, not a default. Extra risk should have a name on it, a legacy, a goal, a deliberate reach for upside. If you can't name what that extra risk is for, it probably isn't for anything. The right amount of risk was never in a questionnaire, and it was never your age. It's where your plan's demands meet today's prices. You now know how to find both. If you want to know your own numbers, your hurdle rate, and the least amount of risk that clears it at today's prices, that's exactly the analysis that I walked through in an initial conversation. No pressure, no pitch. The link's below. I hope you found this video helpful. I'll see you in the next one.